I have spent the last 40 years watching money move. Not just the money in your pocket, but the massive oceanic tides of global capital. I have watched trillions of dollars flow between nations, between industries, and between generations. I have advised sovereign wealth funds, pension systems, and governments on how to prepare for the future. And in all those decades, through the crash of 1987, the dot-com bubble, the great financial crisis, and the pandemic, I have never been as concerned about the average investor's preparedness as I am right now. We are standing at a precipice, a structural fundamental shift in how the world works. For the last 30 or 40 years, we lived through what economists call the Great Moderation. It was a golden era for the passive investor. Interest rates were falling, inflation was non-existent, globalization was making everything cheaper. You could buy a standard index fund, close your eyes, and wake up 10 years later wealthier. It required no strategy. It was a rising tide that lifted every boat. I am here to tell you with the full weight of my experience, that season has changed. Winter is here. The era of easy money is over. The era of set it and forget it is over. The map that worked in 1990, in 2000, even in 2015, is now a map for a world that no longer exists. If you are approaching retirement or looking at 2026 wondering how you will secure your future, you need to listen carefully because the old rules will not protect you anymore. The standard 60-40 portfolio is facing an existential crisis. The assumption that inflation will always be 2% is dead. Most people are sleepwalking into this new regime. They are holding cash that is silently burning away. They are holding bonds sensitive to volatility. They are holding stocks built for a zero interest rate world, not the world we live in today. When I meet with retirees or people 5 years away from retirement, I see fear, the fear of longevity. Medical science has given us a gift. We are living longer than ever. A couple retiring today at 65 has a high probability of at least one partner living to 90 or 95. But financially, it is a massive challenge. You have to fund a 30-year retirement. That is not a vacation. That is a second life. In the old days, you had a pension. Today, the risk has been transferred entirely to you. You are the chief investment officer of your own life. And most people are trying to solve a 30-year math problem with short-term thinking. This brings me to the first asset class you must own before 2026. Asset Class 1, infrastructure and real assets. If you look at the portfolios of the smartest sovereign wealth funds in the world, Norway, Singapore, the Middle East, you will see a massive shift occurring. They are moving money out of paper assets and into real assets. Infrastructure. Not buying a construction company stock. Exposure to the physical backbone of the global economy. The pipes, the wires, the towers, the bridges, the ports, the energy grids. Why? Because in a world of inflation, infrastructure is the ultimate hedge. Think about a toll road or an energy transmission line or a water utility. These assets have pricing power. If inflation goes up by 5%, the toll road operator raises the toll by 5%. The utility company raises rates to match inflation. Their revenue is indexed to the cost of living. This is fundamentally different from a regular company. People cannot stop using water. They cannot stop using electricity. They cannot stop driving on the bridge. Infrastructure provides inelastic demand. It is essential. Furthermore, we are on the cusp of the biggest infrastructure build-out in human history. We are rewiring the entire planet. Consider the energy transition. The world is moving toward decarbonization. This is about the copper wiring needed to connect renewable energy, the battery storage facilities, the retrofitting of buildings, the new natural gas terminals for energy security. Trillions of dollars are going to be spent by governments and private companies to rebuild our energy grid over the next 20 years. And the digital infrastructure, AI and the cloud exist in massive data centers. They travel through fiber optic cables under the ocean. They are transmitted via cell towers. Every time someone uses AI, they are using physical infrastructure. So asset number one is diversified exposure to global infrastructure. You look for public companies, ETFs, or funds that specialize in owning these assets. You are looking for boring. Boring is cash flow. Boring is stability. When the stock market crashes, the water company still collects its bills. In your retirement portfolio, this asset acts as a stabilizer. Asset class 2, short duration fixed income. The second asset requires us to unlearn a habit from the last 15 years. From 2008 to 2022, we lived in a world of zero interest rate policy. Central banks kept rates at zero. This meant cash was trash. If you kept money in the bank, you lost money. If you bought a safe government bond, you earned nothing. This forced everyone to take too much risk. We coined the phrase TINA. There is no alternative. You had to buy stocks because bonds paid nothing. That world is gone. TINA is dead. We are now in the era of Terra. There are reasonable alternatives. The second asset you must prioritize is short duration fixed income, high quality government bonds or corporate credit with short maturities. 1 year, 2 years, maybe 3 years. Why is this critical? Because for the first time in a generation, you can get paid to wait. You can earn a risk-free return of 4 or 5% without taking equity risk. This changes the mathematics of retirement. If you need a 7% return and you can get 5% from safe bonds, you only need to take risk with a small portion to bridge that gap. But be careful. I said short duration. I am avoiding long-term bonds. Why? If inflation stays sticky, long-term interest rates might go higher. When rates go up, the price of long-term bonds goes down. We saw this in 2022. But short-term bonds are resilient. They mature quickly. If rates go up, you reinvest at the new higher rate. You are not locked in for 30 years. Short duration fixed income is your dry powder. Your liquidity. Liquidity is like oxygen. You don't notice it when you have it. But the moment you don't, it's the only thing that matters. Asset class 3, high quality moat equities. The third asset is where we separate gamblers from investors. When I say moat, I am using a term from Warren Buffett. In the institutional world, we call this quality factor investing. In the last decade, you could buy low-quality companies with huge debt, and their prices would still go up because money was free. That game is over. In 2026, debt matters. The cost of capital matters. The strong are getting stronger, and the weak are getting exposed. You need to own the strong, the aristocrats of the global economy. What defines a moat in this new regime? 3 things. Pricing power, balance sheet fortress, and essential nature. First, pricing power. If a company raises prices by 10%, do customers leave, or do they pay it anyway? Think about software that runs global banking, pharmaceutical companies that make life-saving drugs, consumer staples you buy, regardless of a recession. These companies can pass inflation to the consumer. Second, the balance sheet. You want companies that do not need the bank. Companies that generate so much free cash flow they can self-fund their growth. When interest rates are 5 or 6%, the company with heavy debt is working for the bank. Third, essential nature. If this company disappeared tomorrow, would people's lives stop functioning? If yes, that is the investable asset. Focus heavily on dividends. Not just any dividend, but growing dividends. A dividend is proof of reality. Earnings can be manipulated. Dividends are cold hard cash. In a sideways market, dividends provide your return. Asset class 4, inflation-protected securities. I told you we are entering a decade of structural inflation. If I am right, your standard bonds are in trouble. A bond paying 4% in a 4% inflation world gives you zero real return. You are running on a treadmill. You need inflation-linked sovereign bonds. In the US, these are called TIPS, Treasury Inflation-Protected Securities. They are boring, but they are the only asset explicitly designed to guarantee your purchasing power. Here is how they work. The principal value is adjusted upward based on the consumer price index. If inflation spikes to 8%, your principal goes up. You get interest on top of that inflation adjustment. Why is this essential? Because the biggest risk to a retiree is not running out of money. It is running out of buying power. Waking up in 10 years and realizing your $1 million only buys what 500,000 used to buy. Standard bonds do not protect you. Cash does not protect you. Gold is volatile and pays no income. Inflation-linked bonds pay income and protect principal. I recommend allocating 10 to 15% to these securities. Think of it as your cost of living hedge. Asset Class 5, Global Diversification focused on demographics. The fifth asset. There is a concept called home country bias. If you live in the US, you invest 90% in the US. It feels safe. For the last 15 years, the US market has outperformed everything. And because of that, investors have become complacent. They believe the US will always outperform. History tells a different story. Markets move in cycles. The 70s belonged to commodities. The 80s belonged to Japan. The 2000s belonged to emerging markets. The 2010s belonged to US tech. What belongs to the 2020s and 30s? I follow the demographics. Demographics are destiny. Economic growth comes from more workers and more productivity. The West is aging. Europe is shrinking. Japan is shrinking. The US is aging slower. But look at India, Southeast Asia, Indonesia and Vietnam, parts of Latin America. These are countries with young populations. Average age in the 20s. Young people entering the workforce, forming households, buying first homes, opening bank accounts. They are in the accumulation phase. In the US and Europe, we are in the decumulation phase. Boomers are retiring and selling assets. That is a headwind. In the global South, they are buying assets. That is a tailwind. I am not suggesting you abandon your home market. The US is still the deepest, most liquid, most innovative market. It should be your core. But to have zero exposure to the rest of the world is a risk. True institutional capital is global. We search for value everywhere. Right now, valuations in many emerging markets are half of what they are in the US. You can buy great companies for 10 times earnings instead of 25 times. By adding international exposure in these younger growing demographics, you are planting seeds in fertile soil. You are hedging against the stagnation of the West. So there you have the 5 pillars for the 2026 retirement plan. 1. Infrastructure and real assets for inflation-protected cash flow. 2. Short duration fixed income for liquidity and yield. 3. Quality moat equities for reliable growth and dividends. 4. Inflation-linked bonds to ensure your purchasing power. 5. Global diversification to capture demographic growth. This is a robust framework. It is not built for a sunny day. It is built for all seasons. Built to survive recession, endure inflation, and prosper in growth. The year 2026 is coming fast. The changes I have described are already in motion. The train is leaving the station. You can either stand on the platform and watch it go, or you can get on board. Be the CEO of your own life. Take responsibility. Allocate capital with wisdom, not emotion. And remember, the best time to plant a tree was 20 years. The second best time is today. Build your fortress. Protect your future, and let the power of compounding do the rest.